I'm just waiting for the market to crash. If you've ever said those words, you're in good company. Millions of Americans are sitting on the sidelines, holding cash and waiting for the perfect moment to start investing or buy a home. They believe that if they can just predict the next recession, the next correction, or the next big dip, they'll get in at exactly the right time and build wealth faster than everyone else. It sounds logical. Why buy today if prices might be lower tomorrow? The problem is that this strategy has one fatal flaw. Nobody consistently knows when tomorrow's market will go up, down, or sideways. Not professional fund managers, not economists, not financial news anchors, and certainly not the average investor scrolling through headlines. The truth is that waiting for the perfect entry point often becomes a permanent excuse for doing nothing. Markets recover before the headlines improve. Housing markets shift before buyers feel confident again. By the time everything feels safe, much of the opportunity has already passed. Fear convinces people they're being patient when, in reality, they're simply delaying progress. History has shown time and time again that wealth isn't usually built by people who perfectly predict markets. It's built by people who consistently participate in them. They invest when the economy feels strong. They invest when it feels uncertain. They continue investing during bull markets, bear markets, recessions, recoveries, elections, inflation scares, and every headline in between. Today we're going to expose one of the most expensive myths in personal finance. The belief that timing the market is the secret to becoming wealthy. We'll show why consistency almost always beats prediction, and how ordinary investors can use simple habits to outperform those constantly chasing the perfect opportunity. On paper, timing the market sounds simple. Buy when prices are low and sell when prices are high. If only investing actually worked that way. The challenge is that markets move based on new information, expectations, emotions, interest rates, corporate earnings, global events, and countless variables that no single person can accurately predict with consistency. Even professional portfolio managers with teams of economists, analysts, and sophisticated technologies struggle to consistently outperform the market over long periods. If predicting short-term market movements were easy, institutional investors would rarely make mistakes. Yet history shows that even the world's largest investment firms experience periods of underperformance. Individual investors face an even greater challenge because emotions influence decision-making. When markets are falling, fear tells people to wait because prices could drop further. When markets are rising, greed tells people they'll wait for the next pullback. Ironically, both emotions often lead to the same outcome: remaining on the sidelines while opportunities pass by. The financial media doesn't help either. Every day brings predictions about crashes, bubbles, interest rates, elections, inflation, and geopolitical events. Constant exposure to conflicting opinions creates analysis paralysis, making investors feel like they need more information before acting. In reality, more information often leads to less action. The market rewards participation, not perfection. Accepting that you won't buy at the absolute bottom or sell at the exact top is one of the most liberating lessons an investor can learn. One of the most repeated phrases in investing is, "Time in the market beats timing the market." While it may sound like a cliché, decades of historical data support this principle. The reason is surprisingly simple. Compound growth requires time more than perfect timing. Every year your investments remain invested. They have the opportunity to generate returns on previous returns. That's the power of compounding. Missing even a handful of the market's strongest recovery days can significantly reduce long-term returns because those gains build upon one another over decades. Here's another reality many investors overlook. The market's biggest gains often occur shortly after its biggest declines. Unfortunately, that's exactly when fear is highest, and many people are sitting in cash, waiting for more certainty. By the time confidence returns, prices have already recovered substantially. This doesn't mean markets never decline. Corrections in bear markets are a normal part of investing. But history has repeatedly shown that diversified markets have recovered from recessions, financial crises, pandemics, wars, and countless economic shocks. Investors who remained disciplined through those periods were generally rewarded over the long term. The goal isn't to avoid every downturn. It's to stay invested long enough for recoveries to work in your favor. Long-term investing isn't about eliminating volatility. It's about allowing time to overcome it. If predicting the perfect time to invest doesn't work consistently, what does? One of the most effective strategies for everyday investors is dollar-cost averaging. Instead of trying to guess market bottoms, you invest a fixed amount of money on a regular schedule, regardless of what the market is doing. This strategy offers several advantages. When prices are high, your money buys fewer shares. When prices are low, it buys more. Over time, this naturally averages your purchase price without requiring you to predict market movements. Dollar-cost averaging also reduces emotional decision-making. Since investing becomes automatic, you're less likely to delay contributions because of scary headlines or overly optimistic forecasts. Automation transforms investing from an emotional event into a routine financial habit. The same principle applies beyond investing. Whether you're saving for retirement, building an emergency fund, or preparing for a future home purchase, consistency generally outperforms sporadic attempts to perfectly time financial decisions. This doesn't guarantee profits or eliminate risk, but it replaces uncertainty with discipline. And in personal finance, disciplined behavior usually beats emotional decision-making over long periods. The biggest obstacle to building wealth isn't usually choosing the wrong investment. It's waiting too long to begin. Every year spent waiting for the perfect market, the perfect interest rate, or the perfect economic conditions is another year that your money isn't compounding. That doesn't mean you should ignore valuations or make reckless financial decisions. It means recognizing that uncertainty will always exist. There will always be another election, another recession prediction, another inflation concern, another geopolitical crisis, or another headline warning of disaster. Financial success belongs to people who prepare consistently rather than predict perfectly. They build emergency funds. They invest regularly. They keep contributing during good markets and bad. They understand that no one rings a bell at the bottom of the market announcing it's time to buy. Instead of asking, when should I invest? Ask yourself, how can I create a system that keeps me investing regardless of what the market does? That question shifts your focus from prediction to process. And process is what creates lasting wealth. Remember, your greatest investment advantage isn't having better information than everyone else. It's having more time. Every dollar invested today has years or even decades to grow. That's an advantage no market timer can ever recover once it's lost. If this helped, like and subscribe to The Daily Yield because we are making real financial progress, one step at a time.